Okay, can you see my shared screen? Yeah, thank you. So this is the, so first of all, thank you very much for all your feedback and comments. Certainly that's what we can do in the future if we prepare workshop for the business. This is our final day. So this day 3, we've tried to focus on knowing your investors and particularly focus on equity investment, venture capital, and crowdfunding. And we will look into the big page to get yourself investment readiness. There are different things to pay attention to. And we will look through a case study to examine or have a look at the term sheet when you approach to a venture capitalist to try to seek fund from them. So that's the arrangement for today. So at the end of the session, you will be able to understand what's the expectation from private equity, venture capital fund, and crowdfunding, how the structure influences the kinds of investors and kinds of investments the fund sees. And page to win is a big thing to focus on. It's just give you some idea what are the successful factors that lead to successful page, what could lead page fail. Other than that, we will look into the contracts and mechanism can address information problems in assessing finance. The workshop has been fully funded by the Best Growth Hub as part of the Southeast Local Enterprise Partnership. If you have any questions or queries about the services they provide, please contact the Best Growth Hub directly. Dr. Ying Wang from ARU, I prepared the materials. If you have any query, please send me email at ying.wang@aru.ac.uk. So knowing your investors, we will focus on private equity, venture capital, and crowdfunding. Before we start, I want to find out whether any of you have approached private equity or actually seek fund from private equity or venture capital or use crowdfunding platform before. No? Okay, that's one. How about the others?
No, we haven't.
Mm-hmm. Chris, how about your business? Okay.
Can you hear me now?
Yes, we can hear you.
Okay. No, I haven't, but I have started talking to people about it. I've been seeking some advice about it. I'm getting a lot of advice before I dip my toe in the water, quite honestly. But I am about to start.
Okay, good to know. Some mentioned in the chat function that you would like to access crowdfunding in the future. All right, that's good to know that you have some plan to go ahead with your accessing finance. So private equity refers to any investment in equity where the financial claims cannot be readily traded on an organized exchange. In other words, if you get found from public traded exchange, that's not private equity. Any fund outside this public traded platform, that is private equity, particularly like angel investors, for example, they focus on equity investment. That's one of the private equity. And today we are going to look at venture capital. So venture capital style investment is another type of private equity as well. Of course, depends on the investment structure, particularly focus on early stage companies, but also consider some of the unregistered share of public companies that have freely tradable registered shares. So yesterday we also mentioned SoftBank Vision Fund, that's $100 billion, and that's one of the biggest venture capital fund around the world. They invest in a lot of public companies, and most of the funds actually invest into private company and seek the growth of the business and went to IPO in the future. So that's what venture capitalists tends to invest in, particularly the large venture capital fund. Venture capital investment can lead to leveraged buyout or venture capital or distressed debt investment, marginal capital, etc. So that's private equity. A PE fund is an investment fund managed by a PE firm. So now you have a private equity firm. So private equity could be an individual angel investor. For example, in the UK, we are well known that Dragon Den. So you know Dragon Den is the private equity. You speak to individual investor, that's the Dragon, and then that they provide funds to your business. So that's one of the private equity. Another type of private equity is private equity fund, and it's managed by a PE firm on behalf of a group of people or investors in this case. They aim to acquire equity stakes in private companies and divest them over time. So the closed-end limited partnership, for example, normally they have finite lifespan, and typically 10+2 model. What that means is they tend to invest that company for 10 years and then extend 1 year, another 1 year. So that's 10+2 model. And that model normally without early redemption or withdrawal rights. In other words, they can't withdraw their investment before this 10 years. Well, +2 is another consideration, of course. Another mode of investment is planned pool vehicle, which means investors have no say in the choice of investment. It depends on which type of investment you invest in, if it is closed-end limited partnership or it is planned pool vehicle, for example, then the private equity firm will make the decision. You will communicate with private equity firm. They might inform you where your money has gone to, which company you invest in, but you don't have the decision to make which company you want to invest in. So that's the planned pool vehicle. A traditional private equity firm, they rely on success in both raising fund and meeting his target return by effectively deploying and harvesting fund capital. So that is, it depends on whether they can be operate as successful case in a private equity fund. This is diagram about a limited partnership. So you see right in the center is the fund, and here is closed-end fund. In other words, the investors provide capital. So that's the individual investors, LPs. On the right-hand side, the LP stands for limited partners. So those are the investors. They provide capital, but they are not liable beyond their contributing capital. That's why limited, right? Limited partnership. Another one on the top right side, you see GP. So that's general partner, and that is the general partner interested, responsible for executive of the business, and they tend to invest large amount of money into this private fund as well. And then you have the investment manager. So the manager manages the day-to-day business, deal source or reporting, etc. They provide advisory services, and then they try to manage the portfolios for the limited partnership. So that's the PE fund structure. So the global PE fund, this is a cash flow by year. So you can tell that the total distribution for in dollar, that's $1 billion. And then you have the contribution in $1 billion as well. So the light blue is contribution, distribution is the little bit dark blue, and in the yellow line, that's the net cash flow. So you can tell that a lot of private equity companies, they has more contribution rather than distribution. So make a lot of investment, but didn't take their cash flow back. So after 2011, particularly, you see now the private equity make their return back. So that's where if you think about 10 years investment, then they would take longer for them to get their investment back. Last session, we look at venture capital. So you remember the venture capital prefer to have a short-term investment. They might think about after 3 years, we want to have some harvest found from that investment. Therefore, they don't consider 10 years like private equity. Of course, venture capital invests in a company from early growth or maybe mature stage or exists recently. Therefore, the strategy is very different from the angel in private equity or the venture capital. It depends on, of course, which type of investment they're making. So there are a lot of European private equity firms you can see from here. There are different ways, different names here. So in the center, those are the biggest private equity firms. And move to the outside of the circle, you see those are smaller private equity funds. Is the center could be the center size of the private equity is larger than 5 billion euro, and the outsider is smaller than 250 million euro. So therefore, you can see which type of, let's say, private equity fund might be of interest to your particular interest, suitable investors. Venture capital is a category of private equity. It invests in different investment, and the structure of that is similar to the private equity. It has the closed-end mutual fund. So that's closed-end mutual fund, the former fund in that case, and they organize as limited partnership, similar to the private equity. They have limited partners, so LPs, and general partners, so GPs. So general partner has more interest in the venture capital fund. Venture capital, they focus on high growth, high return. Of course, they know that within that high growth, they build in a lot of high risk as well. And they focus on equity investment. They try to identify future unicorns. So this is where they make investment. One of the case I mentioned last session is SoftBank Corp. They invest in Alibaba in China in 2000, and that's $20 million investment. And in 2014, Alibaba went to IPO, and the value of their 20 million investment turned into 60 billion. So that's, to them, is unicorn. Nowadays, recently, a lot of venture capital, they make a good investment, and they tend to have unicorns within 3 years, particularly those companies linked to high technology like AI or the online delivery for the maybe education, for example. A lot of education use the like English platform. In China, that's one of the case, is billion market value within 3 years. That increased quite a lot, and some of them think about go to IPO already. So that's quite quick development of the business after they receive the fund. But of course, venture capital, they might invest in the fund for several stages to have the business grow. The venture capitalists have a short investment horizon, so normally 3 to 5 years. Compared to private equity, some of the angel investors, for example, they tend to have 10+2 model, right? So that will tell you, depends on the project, what your business situation, that will help you to decide who you should try to approach to seek fund. And venture capital, they consider their existing strategy of how to leave companies after success, And for that, they could sell their shares. The company could went to IPO, etc. They think about how they exist the business after they make that investment in for 5 years, let's say. Then they will consider how to make that. They tend to invest in early stage companies. So early stage could be pro-profit or maybe revenue startups, as well as middle stage and late stage companies. The term sheets for venture capital investment is one of the important areas you need to look into if you think about to work with investors from venture capital fund, for example. We had a term sheet yesterday, but we didn't have enough time to go through everything in last session. So today we will particularly look into the term sheets to help you to get better idea if you negotiate with an investor what you need to do. And the companies, the term sheet set out the rights and obligations of investors in a round of newly created preferred share class. So that's normally if you have a venture capital, they have the preferred share. Within that preferred share, they build a lot of rights and obligations in that term sheet. For example, what is the voting power, what is the redemption of the shares, etc. And those actually have a lot of terms maybe you didn't come across before, but that certainly require a lot of understanding of the terminology before you sign up the contract with them. The term sheet terminology, quite often you will see Series A preferred stock, liquidation preference, composition of the board and employees, voting rights, drag along rights, etc. So that's just give you some idea about that. But we'll look into the case study to think the details of a term sheet, but it's roughly fairly standard term sheet for most of the venture capitalists to consider. So the growth of the venture capital, it has quite a few factors affect that. So for example, some factors that restrain risk capital growth in other parts of the world include institutional investors, the key investors in VC fund, for example, pension fund. And many countries they have the restriction on the investment choices of institutions in ways that exclude venture capital. So it depends on really case by case and country by country, depends on where you look into. Recently, the change has focused on late stage investment rather than early stage. So that has a change in that venture capital investment, which you can consider based on the information of your business, which is the right one. In the UK, we have UK Business Angel Associations. We also have British Private Equity and Venture Capital Association. So each one of them provides quite good resources for you to consider if you want to seek fund from them. And according to the report by NESTA, so the return by business angel is about 22%. For the venture capital, yes, last session we looked into that, they could target 25% or even higher, depends on the stage of their investment. We can have a quick look at the website of the Business Angel Association and Private Equity and the Venture Capital Association. I need to share the screen with you. So you see here is Business Angel Association in the UK, and they do provide different information through different tabs on the navigation panel. Of course, depends on what you are interested in. They have the membership if you like. Of course, if you prefer to find out more, some general information, you can navigate the website to see what is useful for you, particularly if you think about to approach to a business angel. They have the services for entrepreneurs and services for investors. So look from the entrepreneur or the business angel, business perspective. So you have here different ways, different areas for you to consider how you can make this work for you if you approach to an angel investor. And they have the advice and the support session as well, which is very useful for you to look into. For the British Private Equity and Venture Capital Association, this focus on venture capital. Of course, they have the private equity as well, so it merged together. For this, they have, if you look into the website, they have the information available about the news, what happens here. And of course, they also have some training opportunities if you like. So for the membership, now you could access more information through the membership, but it depends on what you want to achieve. So just want to draw your attention to the website of the useful resources, then you can use that to help you work on those things. I go back to the slide. So in this angel investment, private equity, or venture capital, there's a benefit for some of the business to use. And one of the benefits links to tax. So the tax matters in this investment regard because for governments in the UK, they provide enterprise investment scheme. So what it is it offers tax relief to individual investors who buy new shares in your company. So that makes the angel investors or individual investors invest into equity investment in a business more attractive. It could reach up for a business, if you reach up to 5 million and a maximum of 12 million in your company lifetime, then you will receive investment under a venture capital scheme of this commercial sale. Using this, the company can go use the EIS, that's the Enterprise Investment Scheme. You can go through the Venture Capital Trust, VCT, the Seed Enterprise Investment Scheme, so SEIS, or if you are running a social enterprise, that is Social Investment Tax Relief, SITR. It depends on which is more suitable for you. It depends on the size of the business, of course. I provide the link in the material I will send to you after today. Then you can have a further look into whether you can consider this type of scheme when you consider to use those venture capitalists or angel investor, private equity investment. So Seed Enterprise Investment Scheme, you can see from the size of this is you can receive a maximum of £150,000 through SEIS investments. For the Enterprise Investment Scheme, that can up to 5 million. So the difference is Seed is more like relatively new business, you start to running, but you didn't make a significant growth yet, so it's not mature stage. Another one is the Venture Capital Trust, VCT, and this is the value of that investment can up to 12 million. So that's where you can do a little bit more research considering the tax matter. Crowdfunding is another interesting one. In first day, we mentioned that for crowdfunding individual investor, they can invest it through crowdfunding. And by doing that, they also can get the innovative finance ISA. In other words, investors can get some tax-free investment return through that innovative finance ISA. So in the UK, we know there are some quite big crowdfunding platform. Therefore, if you are interested in one of them, please do a little bit of research. At least the rewards-based, the loan-based, and equity here. But if you think about the finance you try to seek using crowdfunding platform, then you can decide which one is more suitable. Of course, like we mentioned before, it does require a lot of research time to find out the right investor, which I will share with you some successful factor affect your crowdfunding in a sec. This diagram actually gives you some idea about the return, the estimated return from the angel investing, from venture capital, early stage, or equity crowdfunding, etc. So that gave you some idea about the difference between them and possibly what they are seeking. Actual return is the blue one. Estimate is the red bar. The yellow one is unrealized return, which means they are on paper, they are not realized yet. So angel investing in UK and America, so they tend to have about 25, about 27% return. Early stage venture capital, similar or slightly lower, 25, etc. S&P 500, that's PMU 30 years, is about 10%. So they write that's crowdfunding estimate is about 30%, and that's particularly linked to a company there. Is not the whole crowdfunding platform, but the range is still similar to the venture capital and business angel investment, private equity. Equity crowdfunding in the UK, like Cedars, this is unrealized, could be 10% or lower, but this is not the final number, remember. Some other resources mention that the equity crowdfunding, they also seek to about 25%, 20 to 30% return through that investment. There are different success factors affect crowdfunding. One, the first factor you will consider is people power. And this is what we mentioned before as well. You need to build your network before you need it. And this network in a crowdfunding platform is where it's still like you have this product, you talk to your investors and you tell them, I'm actually raised funds through this crowdfunding platform, and then they will go there to invest in your project. So that's the network. Of course, if you seek to find individual angel, that particular very important with your network, who you know, who you speak to, that will affect quite a lot about the success of your funding seek in that case. Then in a crowdfunding platform, you need to find the right one. Depends on what type of fund you seek to get. Is debt or is it equity? Then you need to find the right platform, and that is where you can find your crowd. The crowd invests in the right platform, but this is where you need to consider whether you know the investor there, whether you trust that platform there. I will show you in a sec what that means as well. You need to explain yourself, and the main is why they should invest into your business. In crowdfunding platform, video is very important, or quality video is the most important factor you need to consider when you make a campaign on crowdfunding platform. You need to promote your project, and that is where you can use different network or social media. Is Twitter works better, Facebook works better, or LinkedIn work better. So this is where you need to know where your potential investors will be, so that that could be the crowd into they will make investment into your investment. So depends on the project, the business. You will have some idea where you find the right investor, and you need to show momentum in the crowdfunding platform as well. You might see quite a lot successful crowdfunding before. You might hear, oh, people get a lot of investment from crowdfunding platform. That is very attractive. However, most of the crowdfunding campaign actually fail. So why they fail? First, of course, you consider the project, the business, and failure to explain the core value of the project. That's one thing you need to consider. And lack of compelling vision, lack of brand identity, and there's no well-known personality there in the project. That leads to the project fail as well. It could, because communication is not promote and is not really touch the right point. The sales point is not really clear to when you communicate with your potential investors, and that could reduce the interest of your investors, and that will affect your potential back to make their decision. You could set up a very high funding goal, and you find that it's so difficult to reach that goal. That could lead campaign fail, but you can take, or you can take none, which means you don't take any from the funding. It's a type of crowdfunding decision you make at the beginning. And most of the cases, some of the business, when they put their campaign on crowdfunding platform, they are not ready to act as a customer service desk. There are a lot of questions about the product, and all the backers will be able to see your reply to that question. So therefore, some business or owners, if they don't put that character into the put that commitment to answer those queries, to reply the questions, then that's difficult to make people trust you will make the commitment to the investment. There are 7 essential tools to raise capital. You need to have a map, execution roadmap, to think about how you can help the team stay on track, how you will show your milestones reached with the investor and future initiative. The infrastructure, whether you have the accumulated data to page. In other words, if you are successful before, do you have evidence to show that you are successful? Do you have the, what is the operational system, accounting system, the documented process and procedures? Those are the infrastructure of the business they will consider in the crowdfunding platform as well. So cash requirements, and that is where you need to have those to run business. Of course, you need to show where the business is at the moment and what is the financial health of the business at that stage. You need to target the right investor, of course, and that will start and routinely making a list of investors, their specific interests and knows from your conversations. So those memo of your talk with investors or track investors' investment behavior, that will be more helpful when you target that particular investor in your crowdfunding campaign. You need to have one-page executive summary. And this one page is when you initially meet an investor, you want to send them information to get their attention. And this one page will include the most important information really about the project. Don't make it too long because people were so busy, they probably doesn't have the time to read it, particularly for investors. You need to prepare 2 pages. One is pitch deck to email, and this is only after you have a potential investor to request this. This pitch deck stands on its own, and it presents the key elements the investor will be interested in knowing. They will provide some details about the project and the numbers, the management team, etc. So this will explain everything. Another pitch deck is when you actually pitch to investor. So this is the one that you will make presentation. And on crowdfunding platform, this pitch deck is the video page. So that needs to serve as a backdrop for your speech, for your video, and it should not stand alone without your explanation. Therefore, this you need to make it interesting, use a lot of pictures, diagram or numbers. Here you need to show more evidence, and you talk over it to support your point. To pitch, you need to focus on several key points. You need to make a powerful first impression. You need to discuss the unique selling points, why they should invest in you, what are the leadership, employee, and external interconnections that could add value to. What is the vision? What is your commitment? And that is where you need to prepare this pitch deck to present with few words and lot of image. You need to find the right trusted advisors, tax strategy, your legal advice, and your financial professionals. So those link to the key elements into your business, and don't go to pitch without good preparation. That will ruin the opportunity to get the investment. The video page, though, it actually is more interesting in a sense. It is more challenging as well, because you don't have this face-to-face contact. You can't keep eye contact. You can't use your body language to show your confidence, etc. But video page itself, it is very important in crowdfunding nowadays. The suggestion is start to examine the other successful video page before begin, and look at successful project and unsuccessful ones alike. So the video, for example, if we go to one of the if we have a quick look at one of the video page quickly, it might give you some idea what could be attractive to investors. So let me share my screen with you. So this is Seeder's website. It's one of the equity investment crowdfunding website. Here you got more idea about different project, and you see the investments, the targets, the convertible, and how they make their investment attractive. You have different ones to consider, of course. interesting, we can have a look at this. For example, this one is valuation is 3.8 million, and the target is 150,000. It's not a huge amount of money. They have 324 investors invest in this already. With 36 days left, they raise about 121% of their fund. So they are successful at this stage already. We've still got a few days left. So this is where they present all the information, of course, their website, the type, etc. And this is the video page deck they make on the website. Not quite sure whether you can hear this. Can you hear the sound?
Reassure you. Don't worry. You don't need.
Yes, we can hear the sound, thanks. No, actually, we can't. Sorry.
You can't?
No.
No, okay. Let me stop that. Sometimes, yes, I think this video sometimes could be problematic. Let me try. Just let me know whether you can hear the sound. Can you hear the sound?
No, it's just a sort of buzzing sound.
Okay.
That's why the lady has a headache.
Yeah. I don't know, this sometimes is difficult, but I will leave you to look into them if you are interested, and particularly for some of you consider to use crowdfunding.
Very useful.
So you need to prepare. I don't need to say that, but the main thing is you need to make it really eye-catching, because people make investment online. Everything they see, they will look into the core value, but they also look into the commitment of the team as well. You need to keep the contents very short, simple, and engaging. Make sure your page clearly demonstrates your product, key selling points, and what makes it unique. So certainly some questions you need to answer is why 5 Ws, for example. What are you raising money for? Where will this campaign take place? When do you expect to be finished? And how you are going to make a return to them? Why should they care? More show in the video page rather than tell. And that will require to use some concrete examples like photos, video clips of your work, etc. The clip doesn't need to be professional or polished, but you need to make sure the segments aren't choppy, poorly lit, or difficult to discern. And the audio is clear and understandable. Be yourself, be natural and upbeat. This is normal, you know that already. And then you need to rehearse your page. You can't believe you think you know what you're talking about. When you make a video recording, when you watch it, you will notice, right, that part is not good. You might need to do this several times to get a perfect page video. Then you can use that one. So that's where you need to prepare and work a lot on this. Of course, you're going to plan, prepare, and then you can perform. However, bear in mind, the expectation is crowdfunding is not magic fund. Therefore, you need to be prepared. You need to think about whether you have the time to spend on choosing the right platform and finding the right investor. It does take quite a lot of time to prepare those documents. And if you are particularly lack of resources and the business is running really in formats, it's not a normal operation, you need more resources, then you will consider whether this fund is urgent to do that now. You need to consider the targets and deadlines when you need a fund, and this takes time, not just you prepare this crowdfunding, all the documents, or the other funding application, even with bank, it also has the time that how long you will get this fund from the founder, either crowdfunding or PE or VC or even bank. So this back to the fundamental is resources management. Some CEOs or management team, they would rather spend time to run the business, to think about their project and go through this difficult environment at this stage rather than focusing on financing at the moment. But I know a lot of business do want to plan ahead, but particularly in the next 1 or 2 years, you don't know whether the business or the economy will return back to normal. Therefore, you need to plan ahead. And like I mentioned, this does take quite a lot of time. You need to manage your expectations. There's no promise that it will be successful. Another bit about crowdfunding links to your copyright issues. Because you make this business product attractive, make a campaign on crowdfunding platform, then you will ask, how am I going to protect my idea? So this is where you need to put a lot of thought before you put your campaign on crowdfunding platform, how to protect your copyright. Of course, it also has the privacy issues or lack of trust, scammers, and some crowdfunding campaign fail. Second time they return, they improve, probably is another fail. So again, this could have issue of loss of reputation, but it doesn't mean you come back, you wouldn't success, right? So it all depends on really the project, the whole page of the crowdfunding you make on the campaign website. So the rise of time, we will look at a case study. Particularly, we will focus on the term sheet of venture capital, fairly standard, maybe a little bit complex term sheet with a venture capitalist investment. So I sent you the file yesterday. You should get a case study 10, TA10. That's case study for fast track. Then you can have a quick look. It's not very long, but it will be useful. I will go through this, but I wouldn't read them out because it's quite long. We don't have time to read them here. So could you please have a look at the case study? If you don't have it, just let me know. I can send it to you via email. Let me share the case study with you. Five to 10 minutes. It depends on how fast you read the case.
Can I ask a question?
Sure.
I don't understand
Mhm.
the section A when it talks about investment, because it says that they'll invest $5 to $7 million
Yeah.
in a preferred at a pre-money valuation of 20 million to 30 million to be determined.
Mhm.
Who determines and how do they determine that value?
This term sheet is proposed by the investor. So venture capital, they propose this term sheet, and basically that's the term sheet agreement between fast track versus the fund seeker, and then the company try to seek fund, and the company that the investor will provide the fund.
So are they saying then that once they put their 5 to 7 million in, the company is then valued at between 20 to 30 million?
According to this proposed term, that is what venture capital investors consider. But of course, the company now, the fast track company now, they have a lot of questions.
Yeah.
Always about this term sheet. That ambiguity and the unclear bit in this term sheet, they want to negotiate, or actually maybe think about to propose a potential counter proposal.
Yeah.
So they will receive this from venture capital
Yeah.
investors, and then the company needs to look into that to, let's say, negotiate to see this is where we don't agree, or this we have some concern. Then both sides must reach agreement, sign it. That will have the legal binding.
So the key thing is that you have somebody with some really good legal and knowledge about this area, because it's very complex, isn't it?
It is very complex, yeah. Last week, I had a solicitor in this session. This part, he does a lot of ask a lot of questions and think really look into that. That is the issue. That is the problem.
Yeah.
Because for the company or the owner, probably you don't have. If we are not solicitors, we don't work in that legal environment. We don't have that enough really background to cover everything. But the key thing, you will need legal professional to support you, to help you go through this eventually.
Yeah.
But at the beginning, the core value linked to the business, you need to know that very well so that you can negotiate. You asked a very good question. There's 5 to 7 million. How this term sheet, the define of this 5 to 7 million shares with that 20 to 30 million valuation is not very clear.
No.
So this is definitely one of the concerns you need to ask, or you need to mitigate the risk linked to this. Because once you send this in the future, if you have any debut or any conflicts, the legal issue will arise from this not very well prepared term sheet.
Yeah, yeah. It seems to me the bigger the difference between the investment and that valuation, the larger the potential problems you could have if things go wrong.
Yes, that's correct.
Thanks.
Would you finish the case study, Alan? Alan, you have a question? You need to unmute yourself. Oh, we can't hear you, Alan. Right, your mic is not working again. Yeah, Mac sometimes it does have this Teams problem. My colleague had this problem using Mac the other day as well. Have you done the term sheet, most of you?
Yeah, although it depends what you mean by done.
Let's say gone through
Yeah.
everything, and of course the second round will look into key or maybe details, and then you will talk about the problems, the challenge, or actually most of the concerns linked to this. I will go through that with you as well in a sec. Yeah, Alan, you log in. Oh yeah, we can hear you now.
Can you hear me now?
Yes, great.
Yeah, on the Mac it doesn't work, but on the Windows computer it works. Right, okay, so I was just quickly reading through this. There is a lot to read through, but it seems that they can basically sell your company at any time, sell their shares at any time, and really, I'm wondering why you'd want to get into bed with these people in the first place, because they can really ruin your company. They can take it from you. They can sell it to someone else. They can break it up. They can do whatever they want just for a proportion of your company value. Why would you go down this route in the first place if someone has that much power to actually ruin your hard-earned business?
Yeah, that's exactly. You find another potential concerns that you want to negotiate to see how you are going to finalize this term sheet with your investor. Of course, if you see this is, if after your negotiation you turn that into terms that you will be more comfortable with, you still can't reach agreement with investors. That is where you will say we couldn't go ahead with take your investment.
Yeah,
it's gonna be the balance.
So why would you take these people's money for a proportion of your company value and give them so much that they can do with your company? They can literally sell your company and shut you down. There's nothing here that they can't do.
Not, but there's, of course, this is not the if you look back how much share they actually convert into, where the shareholdings. Where is the shareholdings? The 70 million. That is where you ask a good question. The investment they make into your business. Of course, we know that no matter VE, no matter PE, VC, or angel, even crowdfunding, they look for higher return.
Yeah.
And one of the higher return that with that, they know that they has risk in that business investments as well. With this shareholding, if they have a lot of investment in your business, you are right. If they gain majority or significant control, in the UK, is 30% is significant control of your company, isn't it?
Yeah.
If it is 50%, that is then majority, or 51 is majority, let's say. So therefore, a lot of business or particular owners, when they think about to get investment with that shareholding, they try to maintain the control So they can sell the shares they hold, but if it is 20%, they don't have the right to sell a company. If they make a significant investment into a business, in other words, if they get 80% of the shares in your business, they can share your company. You are right. You lose control. You lose the power to decide what you want to do with your business. Even think about the business strategy, they might change it as well. And that's the case. Some of the investment, particularly in M&A, merger and acquisition cases, is the business owner, they don't want to own this business anymore. So what they like to do, they run the business for a couple of years for different reasons. They think, okay, I'm happy to be the senior management team to support the business transaction, but I want to exist. I want to make some other investment myself, or maybe I want to open a new business line myself. So I had a new challenge I want to tackle now. So it really depends on, but if the owner, they still want to run this business, they wouldn't sell the majority. They will balance that off. And that is where, of course, depends case by case, if the business is really financial strong enough to not get that controlled investment share from investor. But I know not myself, but my friend's cases, he sold his company, and at that time, he was doing an internet company that was very successful, and really in a boom market for internet, for that insurance industry. So it's a private company, and the value of the company, when potential investor want to buy his company, the value of the company is more than 10 times of the value. And that's where they don't, the owner of the company, they were happy with that, 10 times of value of the business. And then the eventual contract they signed, they asked him to stay in the company for another 5 years to make the transition, run the business as manager. And then suddenly what happened at that time, that was back to 2009, financial crisis came and company value dropped down quite a lot. But he was the one that think, I don't want to run this business anymore. We want to exist. So the 3 shareholders, all of them want to exist. Therefore, they sold the whole company to the investor. Good value. And they took the money to make some other investment. So that's the case. But if you want to run this business yourself, and you think I want to control it, I still have the vision of the business for another 10, 20 years, then you wouldn't consider really, if the finance is allows you wouldn't consider to sell the majority of the share.
Can they force you to make more share sales, more share dividends?
You can negotiate, certainly, and partly come back to this case. We can see that Paul's first question is the purchase of 5 million to 7 million of Series A convertible redeemable participating preferred stock. And that's the Series A preferred stock of the company. And quite often for venture capital, they do this. And the question is, the value of the company here up to 20 million to 30 million is to be determined. So what is the true value? Because if you purchase 5 million out of 20 million, then that's about 25%.
Yeah.
If you put 7 million into 20 million, that will be
33%.
Yeah, more than 33% of the company. That is a lot of uncertainty. What exactly the share means there. Therefore, here, the first thing the company certainly need to do is to come a proposal valuation. What is the value for the business? And then how much they need. For the company perspective, if they think 5 million is enough, they have less share, the less they will propose, okay, you can purchase 5 million. If, however, on the other side, from the project and the business perspective, they need 7 million, then they will say 7 million out of the valuation of the business. So this is first thing they need to clarify. Of course, if it is 7 million, if the value is 30 or the value is 40 million dollar, then that needs to be reflected in this term sheet. It can't leave this ambiguity here to say we don't know the true value. We don't know whether we need 5 million or we need 7 million. So for this, they can, one of the stage they can consider, we might have the first milestone is $5 million.
Yeah.
Once we reach this $5 million, the second stage, we want to have another $2 million. So the total investment will be $7 million. So they can
Would you revalue the company at that stage?
Yes, they can put conditions on this. And if it is 5 to 7, they must have conditions or milestones to make it more manageable, to make the business have more concern about the shares the company can have. Of course, the shares the investors can have as well. So this is definitely one thing you need, the business need to consider. And the fast track company, they did make a counter proposal. So let's have a look. They want to have 7 million. Can you see the counter proposal?
Yeah.
Yeah, you can. Okay. So they make 7 million. They need 7 million. And the value now they want to have, they value the company of the value of the company is 33 million. They propose this. Of course, they return this proposal per counter proposal to the investor venture capitalist. Then they will come back to say, we want to change it to this amount. So that will have several rounds of negotiation. And of course, here you will have the legal professional to support you as well. And the other part linked to that is the preferred stock. So that's the type of stock and that can convert. So convert here, a lot of ambiguity as well. So if this is convert, then it can convert into common stock on a one-to-one basis. Automatic conversion, this is where you can, okay, they can do the automatic conversion. So that is where you need to really think about whether that's the case and what you need to do with it. They also have the anti-dilution protection for Series A preferred stocks. In other words, what it is the venture capitalists, they have, for example, after you determine the value, after you determine the shareholdings, they hold 30% share or 25% share, let's say. If in the future you issue more shares, then that will dilute the control of the investors, the venture capitalists. Therefore, they want to have this in the term sheet to say this is anti-dilutive. You might issue more shares, but we will have this shareholdings in this preferred share Series A. And that's back to last week, yesterday, last session, we did the evaluation, right? So the evaluation shows that the 16% return of Connected Home or 25% shareholding of Connected Home, you see the difference of the valuation. And that is actually in the valuation stage, they will consider this in more detail.
Right.
Anybody notice any other concerns? Do you have any other concerns you want to control for this? Or actually you want to propose a counter proposal?
I would do a counter proposal because it's too one-sided at the moment.
Mm-hmm. So if we can have a quick look at the company's proposal, but you will notice that the proposal from the company, Faster Track, you might have some questions about their ability to propose counter proposal. Some of the proposal even put them into a worse situation, and that's where you need to do a little bit more consideration when you do this type of term sheets, let's say.
Sorry, I was just going to say, it seems to me that you do need to do a counter proposal, but you need somebody who's got real expertise and knowledge to be able to do it for you, because otherwise, as you say, you could put yourself in a worse position.
Yes.
Inadvertently.
Yes. The idea to go through this with you is not to ask you to be a professional expertise in this area. Is actually to show you as an owner or director of the company what areas you need to look into. Yes, you can hire professional to help you do this, but at the same time, you need to know what it is. Will the professional written term down there truly reflect what you want or what you think that will be good for the business? That's another debate. But if, let's say, if you feel that that here got a lot of terminology, a lot of terms you don't really understand, at least you need a second pair of eyes to see that this helps your business as owner. This is what you want. So of course, it's not easy. I mean, for any legal documents, it really takes a long time to understand them. Even you borrow from bank, you have the contract with bank, and that contract mention a lot of things. You need to know, okay, what if I want to do this at the time? Did I break the contract? Do I need to pay penalty? So there are a lot of work to be done, to be honest, particularly with this crowdfunding or with the venture capital or PE fund, because you don't have bank there to support you, or you don't have that that template is the standard as the contract. With you don't have negotiation power with bank, but with VC, with PE, you have this negotiation power, and that's where you want to make the most of this negotiation power in this contract. And the term sheet with venture capitalists, it does give you this opportunity to negotiate. So for example, the Series A stock here, what they talk about is they have a redeemable stock, and they subject to mandatory redemption by the company at 6.5 years after the date of the investment, unless previously converted. And this is where you need another term. For example, what is mandatory redemption, right? So if you have this, it's convertible, redeemable, preferred stock, it make it more complex itself. In other words, the common stock, the preferred stock can convert to common stock. And the mandatory redemption means the company needs to redeem this stock with the investors, and this is mandatory. Of course, they will set up the term how to do that, and here they propose that. Here the counter proposal is for purposes of liquidation or redemption as referenced and subject to limitation of section E and F below only. The Series A preferred stock will earn cumulative dividend at a rate of 7%. In other words, they turn this into, if there is a liquidation or redemption, this can be converted into use this redemption pay 7%.
Is that per annum or at the end of the term?
It's per annum. So fixed Series A preferred stock, what it is. So normally company will issue 2 categories, let's say. The first category share or stock is preferred stock. The second category is common stock. So the preferred stock got the fixed dividend, and that's the cumulative dividend they mentioned here at a rate 7%. So this is fixed. Every year they got 7% return from the preferred stock. Common stock shareholders, they don't have that fixed dividend. It depends on the performance of the company. If the performance of the company was not really good, they make some profit, but not a lot. So the PBIT is roughly okay to maintain the running, but they don't want to pay any common stock. Therefore, common stock shareholder, they don't get any dividend every year. It depends on if they really have a good year, they decide to pay dividend. Common stock shareholder can get dividend, but this is not a fixed for common stock. Back to preferred stock, then you will get the fixed amount dividend, fixed rate of dividend every year. So here they propose 7%, and that's roughly common in this VC investment. For this preferred stock, you could have several types of preferred stock. You could have convertible preferred stock. You could have non-convertible preferred stock. So convertible means you have the right to convert that preferred stock to another type of stock if you want to. If the investor, the shareholder want to convert, they can convert. If they don't want to convert, then they can't convert to another type of stock. They also can have the others like how much voting power you have. That is different categories in the preferred stock as well. Similar to common stock, if you purchase some shares in a public traded company, for example, on London Stock Exchange, you might get voting power shares. You might get non-voting power shares. In other words, whether you can vote on shareholder annual meetings to say whether we want to pay dividend, whether we want to make this investment, whether we want to make the strategy of the business for the next 5 years. So you have voting power in that shareholder meeting. But if you don't have voting power, you can't make that. You will get dividend. You will enjoy the capital gain from share price increase. Let's say maybe they will, maybe the share price drop as well. So it's difficult to say. But shareholders, they are the owners of the business. So they enjoy the capital gain. At the same time, they take the risk. So shareholders will know this is the case for them to take on when they make their investment. And for here, they make other changes, for example, sales and liquidation, and that's one of the query you mentioned as well. And the original one for the sales, that's another big part to consider. So for the sales, in the event of any sale, merger, liquidation, or winding up of the company, except here, the holder of the Series A preferred stock shall be entitled to receive in preference to the holders of any other equity security, common or preferred, amount equal to 2 times the purchase price value of the preferred plus accrued and unpaid dividend. So you see here is the sales, basically what they require here. No matter what happened to the others, we need to get 2 times of our investment plus the unpaid accrued dividends in this case. and then the remaining will be allocated for the other shareholders. So that is the proposal from VC. And the company make a counter proposal. You see, it put quite a lot of thought here, which is good in the sense that they will consider, right, what if the value of the company doesn't increase that much? We lose a lot of value of the business. We couldn't actually pay 2 times of the initial investment when we sell the company. And this is where it's not just about to write this back to the sales and the liquidation preference. It needs to go back to the valuation stage to think, to focus, to predict this. And here they did mention that they, if in the case of sale or merger, etc., the holders of the Series A preferred stock shall be entitled to receive in preference to the holders of any other equity common stock in the following amount. And now they mentioned the value of the company, 200% of original valuation. In other words, the value that 33 million when they sell is 66 million. And the holder of Series A will receive amount equal to 2 times of their original valuation. And the case, while following on, they propose that if it is 200 and 300, and what they will get is they will receive a amount of, here they mentioned that 2 times, and then the holder of Series A prefers stock and holders of common stock shall share the remaining. And if it is at 3%, so they propose a linear formula basis, which why I feel a little bit unsure where this number is coming from. Therefore, you do need the whole stage of this funding. You need finance expert that goes into your valuation, goes into the account. You need legal, which will go through all the legal documents with you, but of course you need to know what will make you better off. And the others is taxation as well. You need tax person because tax person knows for the tax purpose is you probably say, okay, I don't make profit from tax. Yes, but you save your expenses. So that's another way to generate more or save some expenses, generate more spare cash flow for you to use. And then this is where in the event the company at a price greater than 300% of original value when they sell, the company, the proceeds shall be allocated between their Series A and common on a pro rata basis. So now they consider different situation. And remember, we did do the scenario analysis. In the scenario analysis, where we say the business could be success, could be intermediate running, or run as normal, or could be a fail. So therefore, in this valuation, the value of the business proposed as 3, but you do have the scenario analysis, and you, in the valuation stage, you have the probability, how likely that will happen, and then that will reflect the value. And hopefully, if you can link everything together in the term sheet, you will be able to propose a counter proposal to make the business, when you seek finance, make the business better off. And this case is 200 and it's 200. Remember, they talk about 3 years investment, isn't it? So they want to, oh no, it's the, where is that? January. Yeah, we need to go through to find how many years they invest in and how likely the business value will increase. And they would be able to pay 2 times or 3 times of their initial investment. That is where you will need to double consider whether that's the case you want. in the term sheet. And certainly you can set up different conditions. Bear in mind, the venture capital want to have a successful case, but running a business not always successful. Therefore, you need to put that into the term sheet to make the scenario in this case, and that's the condition. Mandatory redemption is another typical term in the term sheet. And back to here is what is mandatory redemption. That means the company will, subject to the mandatory redemption, that they need to redeem the value of the investment from investors, and that is quite critical in a sense, because they want to know what really how much value it is. Can the business actually redeem that value in that investment? And a lot of changes you can see from the counter proposal nearly change everything. And there's main consideration for this is now they have different, again, they think about different scenarios, they think about the fees, and they think about how to distribute this among the preferred share with common share. That is more thoughtful in a sense, because they consider the finance in the case come to the mandatory redemption date. So that's quite a lot to take on as well. I understand if it's not a legal expert, it could be another overwhelming cases to not know what they mean and what that refers to really in a business. There are other, of course, the provisions that you need to consider as well. So I totally agree. If finance terminology is very new, what that means to a business is new too, then you need to really go back to the term, at least speak to the expert professional. If you get that in your term sheet, in your investment, you need to look into that to fully understand that before you send this term sheet. Part of the reason is this term sheet not just affect the investment today, now, it will affect the future event when the business come across different event or situation that will affect this investment as well. So you see the sale of business is this H, and then they delete the sale of the business, like you mentioned, why they want to allow them sell the business. So this whole term item in the term sheet, the company delete them when they propose the counter proposal. They don't want this happen, and certainly you have the right to propose the counter proposal and then come into negotiation what is the best for the business. And that's the big concern in terms of sales of business. The other changes, well, they accept some of the items like the expenses, they accept it, and the board of directors is another case that they propose want to change it. So the original one for the board of directors, so the Series A preferred stockholders will nominate someone as board members, and they want to the common stockholder will nominate board members, and then directors will be nominated by mutual agreement of the Series A preferred stockholders and common stockholders. Meeting will take place at least 6 times a year, non-local directors to be reimbursed for reasonable out-of-pocket expenses. So that's the director proposal from the investors, venture capitalists. So I wonder if you were the business, in terms of board of directors, what is your thought, for example, to think about these board members? How you want to make the counter proposal? You happy with it? You think, okay, we accept this, or do you want to change it? Or you might have an idea how many board members the common stockholder can nominate, how many preferred Series A stockholder can nominate. What do you think? Any idea? Of course, it depends on the original company's corporate governance structure, how many board members you have. So here, the fast track company, they propose the counter proposal. They don't want to nominate this and that. What they want is they want to immediately following the closing, the board of directors share consists of 5 persons, 2 of whom shall be nominated by the holders of Series A preferred stock. So they allocate the Series A preferred stock you can nominate 2 out of 5, and the others, they don't want to have that limitation. In other words, if the owner owns about 70%, they want to make that 3-person more flexible for them to consider. Another item they remove from the proposal is the Series A preferred stockholder will have approval rights for all key management positions and employment contracts. So they completely remove these items from the term sheet. So you can see from here, of course, the board of members, it varies. When you propose this, you need to consider your company's corporate governance structure. And if you want to make a decision, let's put that into scenario. If you make a decision, who is the chair of the committee, of the board of directors? Who is the CEO or the CFO? So this is where you can negotiate with the VC. We see venture capitalists sometimes they want to share their expertise and networks with you. Therefore, they want to nominate directors. For example, they want to have someone from them, particularly when they make a lot of investment. They want to nominate that directors to run the business to ensure this is on track. Part of the reason is they make a huge investment into the business. But of course, how to allocate this membership in the board of directors is down to negotiation. Another change in this, some other proposals linked to no stop provision, but that is very professional, like the mandatory redemption, voting rights, and dividends, the protective provision. Those are very professional, probably quite difficult to pick it up within a short time. But I think after you read this, you pick up 2 or 3 very important messages immediately, which is very important in a sense, because you mentioned shares, valuation, and the sale of the company. And you can tell from the counter proposal, you can negotiate. So the sale of the company completely be removed. Valuation and shareholdings of the investment is the change as well. Breakup fee, another important part here is to consider what will happen if they break up. Of course, it's case by case. You can negotiate, and confidentiality, they agree to keep the terms of this agreement confidential. So this is the venture capitalist group, and this is CEO. So this is pretty much very standard, but maybe a little bit complex term sheet for venture capital investment. If you consider crowdfunding, then crowdfunding for seeders in the UK, they have this term sheet is running differently from traditional venture capital investment. So the investment structure, seeders is the platform, crowdfunding platform, right? So we had a look at that in day 1. So seeders, they attract individual investors, could be any investor like you and me, and maybe business. They make investment into that campaign on seeders. So you can tell from this investment structure is different from the case, the very much standard term sheet we look into. So the seeders will act as nominee. So what that means is when investor hold under the seeders nominee structure, which is the default position when investing on the seeders platform, seeders will hold the shares in your company on their behalf. This means that seeders as nominee will be the only shareholder listed in your cap table and company register for the seeders investment. Seeders will take care all the paperwork and general administrative communications with your investors. So here they make that you can communicate with your investors and seek support from your investors, etc. The shares will be ordinary shares. So there's not, so for the term sheet with crowdfunding platform, they're not doing Series A preferred share. So relatively, this crowdfunding platform compare with venture capitalists, they have a more flexible format. Part of the reason is individual investor, they might make a fairly small amount investment into the business. So seeders as the platform manage this project on behalf of their investor. So they issue ordinary shares, in other words, it's common share. And they, as nominee, seeders organize the administration and voting on behalf of those investors. So if you are considering crowdfunding, you need to look into their term sheet to see whether that's what you need. And of course, this is quite a popular platform at the moment, no matter big or small. More and more business considering, particular SME considering use crowdfunding platform rather than traditional banking, particularly when they don't have a lot of track record or fixed asset as secure equity to seek fund from bank. There are more items here. I will send this to you as well. You can look into them in more detail, including documentation, due diligence, and that's the key terms. You can tell that this is different from traditional venture capital term sheets, but it depends on which one you use. If you use other platform, you need to check their check their term sheet in that case. So let me share the slides with you to end the session. We're nearly there. So in the takeaway, well, that's the case study. We had a bit discussion, but I will send you the discussion sheet as well. You can have a look in that regard to see what you can do. Then I will share with you a standard venture capital term sheet sample. Of course, we have in 2 days to look into them. That will be helpful for you to consider what you need to pay attention to. The crowdfunding platform term sheet, I will share that with you as well. Those are the resources. Do we have any questions regard to today's session? Anything you want to discuss before we finish today? Lily?
Yes. I'm just wondering because obviously it sounds to me, investors. I know some they are professional investors. They just do that as a living. But some investors they have fund managers. Am I right to understand in that way? But the fund managers they work for the investors. Is there a similar support, not for investors, but for businesses like us, actually can negotiate, can help us to think through and put us on the journey, and also the whole session, I think, for myself, for our company, it's really not something you can learn just short term. Then you can market, then you can go out.
Yeah.
To put up. Surely there will be some professional bodies there. But do you have any idea? Is there any professional support to support the businesses?
British Business Bank, they have quite a lot of free resources for you to look into. PEVCA is another one, BAA is another one. Those are the free resources. Of course, if you, after you do your research, look into the free resources, if you want to find the investor per se, then you might need to go to some, you need to pay fee to access some of the resources, fairly speaking.
Yeah.
There are some companies in doing this type of services. In the UK, there are quite a lot as well to help SME to fund their investors. They might, some business in the UK, I know they have their own bank of investors. They build their own portfolio, maybe small, maybe big. It depends on how much you need, but they don't do it for free. You need to pay consultant fee or pay the other charge for the work they do for you.
Yeah,
it depends on, but no matter what, from my perspective, if this is where you see your business will get more finance from, or maybe in the future you consider PEVC or angel or crowdfunding, certainly first thing I would suggest you do your own research. But if it is other case, if you say I'm very busy or my resources is limited in terms of researching, in terms of doing those myself, then you can approach to one of the companies to ask them to fund the right investors for your business. But like I say, it's quite expensive to go through that process. Then you need to seek whether you can get to the money you need, even you pay the fee to get to the investor. Even the last minute, you have all the document ready. You probably still wouldn't take the investment forward because the key term, you couldn't reach agreement with investors. And like I mentioned before, certainly one of the research or one of the things that helpful is to networking with venture capitalist or business angel. If you can, then they will be able to take you directly to the consideration of the venture capitalist rather than through a business. But of course, I know it's very difficult to find the right investor, particularly under COVID-19 situation. But do some research, certainly. If you really tied up with resources, with the business running, then pay to get those done by the other commercial companies.
Okay, thank you. Yeah, certainly we will do a lot of research ourselves.
Yeah, that's right. It takes time. And that's why even you apply for bank funding loan, you still take time to prepare all the documents. But it doesn't promise you will get the loan. So that's the fate. But if the business idea is great, you have a vision of the project for the future, you foresee the future cash inflow will be promising, don't give up funding the right investor. It takes some time, but I'm sure it will take you to the right investor after you do a lot of hard work. It will reward you.
Okay, thank you.
That's okay. Any other questions or comments?
Hello.
Yeah, we can hear you.
Yeah, it's Chris. Just to say thanks very much. You've given me a phenomenal amount of work to do going through all this, but I think it's going to be worth it. Yeah. No, it's very interesting. Thanks very much.
Okay, thank you.
Yes, I second that, Ying. Thanks very much for your help.
Okay, thank you. Thank you very much, Paul. Any other questions?
No, I need to
go ahead. Yeah, we ran a little bit late. Sorry about that.
I need to rest my head.
Yeah. All right. I will share all the materials with you like normal. And if you have any further points you want to discuss, please feel free to contact me.
Thanks very much. Appreciate that.
All right. Thank you very much.
Thanks. Bye.
Have a great weekend. Bye.
Bye. Bye.
Bye.